In this video, we're going to be talking about the classification of mutual funds. The classification is important for you to know so that you can have better conversations and make better decisions on the types of funds that you invest in. Classifications can be of various types. You can classify funds on the type of investment or the applicability of taxes, the type of management, transactional availability, investment style, and others. So if we break it up into type of investment, equity funds primarily invest in stocks of companies. Debt funds primarily invest in bonds, debentures, or government securities. Hybrid funds invest in stocks, bonds, commodities such as gold and silver, and real estate. Solution-oriented funds can invest in equity or debt in varying proportions. These are funds that target retirement or children's growth, etc. And then you have other funds that comprise of, like, say, index funds, exchange traded funds, or funds investing in other funds. If you look at it from a taxation perspective, equity oriented funds are those that hold more than 65% of their assets in equities. Debt oriented funds hold more than 65% of assets in debt. And other funds are anything that falls outside of these two categories. Examples would be hybrid funds or fund of funds. The tax slabs for each of these categories will be covered in the next video. Tax rates and categories can change every year, so it's important to keep up with these changes. If you look at it from a type of management perspective, and when I say type of management, what I mean is active management, where the fund manager is consciously looking at the portfolio regularly and taking decisions on buying and selling securities based on cash flow needs, based on performance of securities, etc. So the fund manager is actually focusing on what's held in the fund and deciding whether something is worth holding on to or whether something should be sold and something else should be purchased as a result. If you talk about passive funds, each fund has a benchmark. So for example, a large cap fund would have either the Sensex 30 or the Nifty 50 as a benchmark. And an index fund that follows that particular benchmark would invest exactly as per the benchmark. There's no variation really between the index fund and the benchmark except for like tracking errors. And the manager doesn't really take any conscious decisions in this regard, just follows what has happened on the exchange the previous day. Open-ended funds are those that allow an investor to buy into the fund or sell out of the fund at any time. And these are the most common funds out there. You also have closed-ended funds. In these funds, the investor can buy into the fund only in the offering period before the fund is launched and can receive money back only once the fund is closed. And some of these funds may have a 2-year or a 3-year or a 4-year horizon. It could vary. Some may even have a 10-year horizon. These funds can be sold on stock exchanges prior to closure, but finding a buyer and getting the correct value is not easy. In most cases, the value that one would get when selling on a stock exchange is actually lower than the net asset value of the fund. You also have interval funds, which are kind of like closed-ended funds, but the difference is you get a small period every year in which you can pull your money out if you would choose to do so. If we look at classification in terms of investment style, we look at equity first. If you talk about growth, the fund manager is looking at sectors that the fund manager expects to do well. Examples could be pharma or defense, etc. And within those sectors, the fund manager is then looking to identify securities that they expect to do well. If you look at value, the fund manager is primarily looking at securities that they feel are undervalued and whose price will come up as the company continues to perform. If you look at it from a debt perspective, there is one style which is related to interest rates, And the fund manager is looking to make money for the fund based on interest rate movements. And what ends up happening is, as interest rates go down, prices of the securities go up, and vice versa. So the fund manager is taking decisions based on how they expect those interest rates to move. If you look at the credit strategy, there are funds that are specifically looking at companies whose credit ratings are lower than they should be. And as the credit rating comes up, the value of the securities also comes up. And so they're looking to make money for the fund in that way. And if you look at other classifications, a dividend yield fund is one that invests in stocks that pay good dividends or high dividends. Um, Sectoral funds are those that invest in a particular sector. Examples would be pharma or banking. Thematic funds are those that invest in a theme such as infrastructure or consumption. And the difference here is, if we use infrastructure as an example, infrastructure could contain companies from multiple different sectors that are helping in building the infrastructure for the country. ELSS or equity linked savings funds are basically funds that provide tax benefits in the old regime. They have a 3-year lock-in though, and your money would be tied up for that period. Dynamic allocation funds are funds that invest automatically based on rules. Index funds that we covered earlier invest as per the assigned index, and there is no active management in these funds. Exchange traded funds are very similar to index funds but are traded on stock exchanges and can be considered stocks. Fund of funds invest in one or more funds. Hope this video was helpful. Do contact me at the email address or the mobile number provided. Do check out my website, which is www.aditshah.in. Links to all the social media pages are available there. Do follow me if you found this video helpful. Thanks for your time. Take care. Bye.